All right, guys. So we are here today for the Fed Minutes report. I'm going to drink my coffee here, and then we're going to get started. All right. So today is the Fed Minutes report. It's the FOMC Minutes report. It's a recap of the last FOMC meeting we did 3 weeks ago. An interesting look at markets for sure. And yeah, we'll see what we get. We'll see if the Fed gives us some foresight into what we might potentially do in March. The question today is whether they give us some information on when a potential rate cut's going to happen. Who knows when it's going to happen, where it's going to happen. I think it's going to be June plus before we start doing rate cuts. Inflation is still sticky. I still think, the Fed is taking a very quantitative tightening approach. They've been reducing their balance sheet for, a good bit now. And I think they're probably going to keep doing so and keep doing passive QT, at least for the rest of this year. Maybe not. They might stop doing quantitative tightening. But again, we don't know when that's going to be. We don't know what that's going to look like. And yeah, let me know what you guys think. When are the rate cuts going to start? We'll give you some more information about, if you don't know what all this jargon means, we'll talk about it in a second. But the Fed lately has been reducing their balance sheet. There's a lot of nuance behind it I'll go over in a second. You can see Nvidia is one of the stories of today. We ended up cutting PANW. The SPY recently cracked lows. Look at this low break here. Something happened. This looks like a fundamental reaction of some sort. Let's see what it means. Okay, so the U.S. is still doing quantitative tightening. They just sold 16 billion 20-year bonds at 4.9 or 4.595%, tails by 3.3 basis points. And this might be a good a good lead to what all of this means. So give me a second. We'll talk about it. Alright, so again, remember, nothing we do or say here Alright, so there we go. So we got that live. Let me make sure we got this monetized. There we go. Okay, that looks good. All right. Y'all can hear the music, right? You should be able to. Yeah, so, okay. I see people talking about the bond auction. Yeah, that's what's dropping the market. You can see it right below me. Basically, okay. So, the Fed... let me think of the easiest way to start this conversation. A lot of y'all don't understand what any of this stuff is, and that's okay. My channel's called Beginner Trading. That's kind of what we're here for. So, all right. So the Fed's job is to keep a balanced economy. It's not necessarily pushing for it's not always pushing for a super robust economy with free spending, because ultimately too much of anything is bad. Right? Like, you can take too much Tylenol and it's bad for you. And so a strong economy can be bad in its own sense, specifically because inflation can get out of control. So the Fed has a couple tools to combat this, right? When the market is struggling, we can go look at 2008, we could look at 2020 after the pandemic. One of the Fed's tools is called quantitative easing. Quantitative easing is essentially money printing. What the Fed does is they create digital money, and with quantitative easing, they can send stimulus checks to us. But what quantitative easing does is they end up buying bonds with that. When they buy bonds, it pushes. Hold on, I gotta sip my coffee. When they inject that liquidity into the market through bond buying, it stimulates the economy, eventually helping banks to lower interest rates. It eventually trickles into interest rates to consumers, and when consumers pay less interest, they spend more, right? Stimulating the economy. That's essentially what happens, is that the Fed's trying to stimulate the economy through quantitative easing and money printing, and so that's essentially what they do, right? That's what we saw a lot in 2020, the pandemic. People were struggling. A lot of people weren't working. The whole economy was in turmoil. And what did the Fed do? The Fed injected liquidity into markets, basically allowing banks to lower interest rates to consumers and then giving the customer, people, more money to spend, because if you're paying lower interest rates, let's just use mortgages as an example for the interest rate conversation. If you're paying less in mortgages, you're going to have more money to spend on other stuff, thus stimulating the economy, and that's how it works. Now, the problem with that is that inflation gets out of control in those moments. Why? Because there's so much spending. Again, we talk about Bernard Arnault being one of the richest people in the world. He's the CEO of Louis Vuitton. He owns Hennessy. He owns all these different luxury brands. When you give the people more money, they're going to spend it, right? And sometimes they're spending it on nonsense like luxury goods. The price of Rolexes is appreciated well over 100%. Louis Vuitton purses are more expensive now because, again, you gave the public more money to spend and it stimulates the economy. It helps businesses and all this other stuff. But inflation gets out of control. It gets rampant. In I believe it was May of last year. Not last year, the year before. In May of 2022, interest rates, inflation was like 9%. So one of the consequences of quantitative easing is high inflation. Prices have gone up too much. One of the Fed's got a couple ways they can combat that. But what they do is they can raise interest rates to consumers. They can raise the federal funds rate short term, which is overnight holding interest rate, but eventually it trickles into everything else. And by raising the federal funds rate, eventually it hits interest rates for banks. It makes banking more expensive. Banks raise interest rates to consumers. When interest rates go up, we're going to use mortgages as our example here. Consumers have less money to spend because they're paying more in interest, right? And so what do? They stop spending as much. When they stop spending as much, inflation goes down. That's the cycle of all of this stuff, right? That's what the Fed does. And so lately we've been pausing interest rate hikes. The last meeting we had, we've paused interest rates, I believe, since July. I think that's the date where we last raised rates. We were raising rates by 50 for a certain period of time, and then we started raising them by 25 basis points, and then we paused rate hikes. The question is, when does the Fed start to cut rates, which is a much more dovish thing. Hawkish means a contractionary monetary policy where we're trying to kind of push the economy down because of inflation problems and we raise rates. We've been in that period for a few years. Inflation was out of control prior to this as well. Inflation was almost 9%, and so now we're kind of past that. Inflation has slowed. It very rarely goes down, but it's slowed down. And that's the ultimate goal of quantitative tightening and all that good stuff. The bond auction, going back to the bond auction, the Fed is currently in a period of quantitative tightening, which means they're trying to reduce their balance sheet. When they reduce the balance sheet... Sorry, I'm drinking my coffee here. Let me catch back up on chat. Hey, what's up, Connor? Are you all right? So today is the Fed. I'm sorry, loud over here. Is that where Nvidia's at, bro? Okay, no, it's not. I always hate it when I see that number. I'm not a super religious person, but still, I don't like that number. Anyways, the point right now is that we've had our period of quantitative easing where we've wanted to stimulate the economy, and we did during 2020. Everybody was out of work. We stimulated the economy. We printed money. We lowered interest rates almost down to zero or very low. Not quite zero. 2008 was almost zero. But anyways, we've lowered interest rates. We've caused people to spend money. And now that's been out of control. The last couple of years, we've been kind of trying to reel that in. The Fed's been what's called in a period of quantitative tightening, which means they're selling their balance sheet, which is bonds. A lot of it is bonds. And so the Fed's selling their bonds, right? And when the Fed sells their bonds, typically it creates... when the Fed sells their bonds, it's from quantitative tightening. It's reducing their balance sheet. Hold on. For everyone that's curious, let me break it down for you in detail. So there's a news article stating that this happened recently in... What? How about XAU USD? How the big options flow. Nvidia, what's the percentage chance the FOMC minutes is already baked in and we go north from the dip? I don't know. A lot of the time the move doesn't happen. Sorry, I'm getting distracted. I looked up quantitative and it's defined as another for quantitative. Quantitative. Yeah. It will go up. Do you think gold is going down or up or down? I think this is just a reaction to the previous Fed meeting, right? So this is just a reaction to the previous one. This is just a reaction to the previous Fed meeting. And again, the next one will be in March. We also have Nvidia earnings today, which will be chaos. I'm excited for them. We'll see what happens. I'm drinking way too much coffee today, and it's only about 12 o'clock my time. Another aspect of this is mortgages, you know, so like the Fed's been in their quantitative tightening period for a while now. They said they don't know when they're going to stop. The last FOMC meeting in July or in late January, they said that they would begin to slow the reduction of the balance sheet. Like they would stop selling off, or they would stop their quantitative tightening, their reducing plan of their balance sheet, either late this year or next year is what they think. Now, they can always change their plan, but if you want to know when interest rates are going to start going down, that's when is when the Fed starts to, you know, stop selling bonds, which, again, you can see at the bottom screen, they just sold some bonds that made the market drop. Means we're still... Can you explain more about what's being discussed in news now? I don't know what the target level is for gold. No idea. A few calls coming up this week if it... Yeah, I mean, bro, that's not the way you grow on YouTube, brother. Sorry, dude. Where can I watch the news? We're going to cover it live right here. We're going to put this up on screen. We're going to cover it live like we always do right here. Alright, we're going to put this up. So yeah, government just sold more bonds. Now, what this could mean for bond prices, though, is that, let me see, I'm sure the 10-year is up with the market and with this. Yeah, so the 10-year is up. You can kind of see, so if you want to know the correlation between quantitative tightening in bond prices, and bond yields, I should say. The government selling bonds tends to make the yields increase. All right. It does that because it increases the supply, makes them more competitive, so the yields go up. And vice versa, like in periods of 2020 where we were doing quantitative easing, and the government's buying bonds, that's raising the prices of the bonds and lowering the yield of it, because with them buying bonds, there's less supply, and so yields go down, price of the bonds go up. You can kind of see that's what we're getting now. Here's the 10-year yield. It's up to about 4.3% right now. The SPY up to over the volume weighted average price, the 200 EMA. And, yeah. We'll put gold up. We watch gold a lot. I'm in gold right now, but we'll see what happens here. Here's gold. Gold currently priced at 2030s. 2034. So, SPY very flat, very choppy. We stopped trading earlier today because market was flat, and we thought the market would stay flat. Hey, thank you, Kimberly. Appreciate it. Bonds kind of sound like bondage. Get your mind out the gutter, dude. Get your mind out the gutter, bro. How do you think the market will react? It's impossible to tell. This is not a press conference. I'm going to put this up on screen. This is not a press conference. This is instead a reaction to the previous press conference that we had at the end of January. But gold tends to follow the broad market. It's not exact correlation, but it tends to follow the macro market. So gold, unless we've got like a specific sector that trends against it or whatever, gold tends to follow the macro market. So again, here's gold over the year. Here's the market over the year. It tends to follow. It's not an exact correlation. It's not as easy of a correlation as some other stuff, but like it tends to follow it. You get big dips. You get the dips in the price of gold, rebounds. It's all inflation hedges in the end, right? Like these are all inflation hedges. Bonds is going to move on a macro level. Bonds move kind of with everything as well, but they fluctuate and they're a lot more nuanced. But they're all inflation hedges, right? These are all inflation hedges. If you don't hedge against inflation long term, you're going to lose money. And so all of these things' purpose is to hedge against inflation. If you're sitting on cash, bonds, essentially treasury bonds, are loaning the U.S. government and getting interest payments for it, right? So if you buy bonds right now at 4.3%, you spend $100,000 on 10-year treasury bonds right now. Every year you're going to make 4.3% return on that 100K. You're going to make $4,300 a year every year. And then at the end of that 10-year bond period, which is called maturity, when the bond's over, when the period's over and you get your money back, it's called maturity. 10-year bonds have a 10-year maturity. You're going to get your $100,000 back. So over a 10-year period, you're basically going to make $43,000 over 10 years if you buy 10-year government treasury bonds right now. That hedges against inflation, keeps up with inflation to a certain extent. Some people hedge against inflation by buying gold. Some people hedge against inflation by buying gold. Some people hedge against inflation by buying the S&P 500. Some people hedge against inflation by buying real estate. They're all ways to hedge against devaluing of the dollar, which is an inevitable thing. It's going to happen over time no matter what. Oh. Okay, maybe my mind's in the gutter shining. It's all good. 1 month T-bills are about the longest I loan money to the Treasury. Yeah, I mean, I think, okay. I think short-term bills tend to react more to rate hikes, right? So shorter-term bond yields increase a lot faster from rate hikes than longer-term yields. And so I think they're a little bit easier to play with, like the Fed's decision making. Like at any period of time, it's easier to correlate what the Fed's doing now in terms of monetary policy with shorter term bonds, right? Because they react a lot faster, and it makes sense when you understand the dynamic of like bond prices versus yields and how that plays out over long periods of time. Shorter term bonds react a lot faster to economic policy, I guess is the easiest way to put it. So you can kind of correlate it easier and trade it and get some good ideas from that. But yeah, I get it. I don't think we're going to cut rate until June. I don't think we're going to cut rates until at least June. Maybe I'm wrong. I don't think we're going to cut rates until June, though. What do y'all think we're going to cut rates? Let me do a poll here. This is probably the biggest question we could ask right now. When does the Fed cut rates? We're going to do March, May, June. Let me look at the graph here. There's the poll. When does the Fed cut rates? Vote of the poll. What does it need to strengthen the Dixie? I think something that strengthens the Dixie is a weak market. A weak market. So if we look at the Dixie here, it moves inversely typically to the markets. The Dixie's down over the last year, slightly down at least, maybe break even. But if you want the dollar index to go up, you want the Fed to be bearish, and we'll see what happens there. It all tends to follow up over time, but the Dixie moves inversely to markets most of the time. So if you look at it, if you zoom in, and then you look at the SPY, both intraday, they're gonna look similar but opposites today because they're both choppy, but one's choppy on the upside, one's choppy on the downside, but they're both choppy. Like the SPY is red today, the dollar index is green, but they're both flat. They do move inversely to each other. The Fed will cut 3 times in June in 2024. Why do you think that? The meeting's not right now. There is no meeting right now, guys. Again, just to put this into perspective here, team, the FOMC Fed Minutes report is a huge 12-page long document that details why they made the decisions that they did in the last Fed meeting. It's a Fed meeting reaction. It's a reaction to the last Fed meeting, a minutes report to the last Fed meeting. That's what this is. Fed said last year they will cut 3/4. Oh, well, bro, last year everything's changed since then. The Fed said that they would raise rates multiple times before the year end, and they ended up pausing for the rest of the year. So what they said last year is insignificant. What I'm seeing right now is that the Fed is still in a period of quantitative tightening, which means that the Fed is still selling off their balance sheet, or at least not buying bonds with passive QT. And I think what Powell said was they're not going to stop limiting their balance sheet until late this year or next year, right? So when the QT stops, this is either going to be late this year or next year. If you want to know when interest rates are going to go down potentially, that's kind of a gauge of it. So who knows when they're going to stop. I don't expect any cuts before August. Yeah, I don't know. Maybe. I'm not sure. I'm buying tons of stocks before March. The real question, baby, is do you think the market's going to react positively to rate cuts and dovishness by the Fed? Do you think it's too early? Do you think inflation is still out of control? I think that's the real question, and I think it's super nuanced. So you seeing buys today for indexes? I'm not actually. I'm seeing sells. I'm not buying anything right now. I stopped buying a couple weeks ago for the most part. And I'm typically a bull, but I'm bearish right now. I think the market's up a lot. I think it needs a correction. So that's kind of where I am right now. Alibaba ripped up really nicely though. Tesla up today as well, I think. Yeah, Tesla's flat on the day, but still. First cut is in September. Yeah, if you're still looking at what the Fed said last year sometime about rate cuts, again, things have changed so much since then I'm not going to say it's completely insignificant, but I wouldn't hold my breath for that, Especially, we have to look at what the Fed said the most recently, and what the Fed said most recently was that we're still not out of the woods. They're going to remain hawkish, that they don't think we're out of this in a soft landing period yet, and that they don't know when they're going to start reducing rates. So that's what they said last, and so I don't think it's going to be in March at all. I think if you look at the probabilities for all this stuff as well, right? Like if we look at the probabilities here for all of it, the likelihood that we're going to get a rate cut in March is less than 7%. You can see 93.5% of people expecting a continued pause in rates. In March, only 6.5% of people think we're going to get cuts. If we look at May, May is still most people expecting a pause. Only 29% of people expecting a cut in May. Again, I think it's going to be June, personally. If we do cut rates, I think it's going to be in June. June is when it pivots as well, and really I'm just kind of going by the percentages here. But June, 53% of people think we're going to start cutting rates in June. So over half of the people think we're going to start cutting in June. But even still, 27%, 28% still think we're going to continue pausing in June. And so the real question is when, you just got to watch what the Fed does. Another interesting dynamic of all this is in March, we do have this, before the next FOMC meeting, Powell speaks to Congress. He's going to be doing testimony in front of the House and Senate. It's called the Semi-Annual Monetary Policy Report to Congress. He does it every year. That's going to be early next month, right? And so that is a real question or that might answer some questions on when the Fed is going to cut rates. I just don't think it's going to be in next month. I think next month is too early. I think we had inflation data come out last week that was noticeably higher than expected. And so I just don't think it's time to cut, personally. But who knows? I might be wrong here, and maybe that happens. I think they will raise it in June because inflation is not where it needs to be. I don't think so. Raising rates in June? Nobody expects them to cut rates. It's not even it's in the graph in June. Most people are expecting a pause, I'm pretty sure. But yeah, pauses are expected. July, most people are expecting a 50 basis point, but July is pretty far out there for us to start making bets on what the Fed does. They change a lot. I think the Minutes report will reinforce the Fed's stance of being patient about starting its easing cycle and validate the market's pushing out of rate cuts to June meeting instead of March. Yeah, I think that's what we're going to be looking for in it for sure. We're going to use AI to interpret it. Your view on the impact of stock market and election period. I have no idea how the market's going to respond to elections. Truly no idea. Typically, I would say the market goes up from elections, right? The politicians tend to want it to. But I don't freaking know, man. We'll see. Even if they pause the rates, it is still tightening the economy as real rates are going up. Yeah, I mean, for sure. We're still in a quantitative tightening period. They just sold bonds today. They did a bond auction today. And so we're definitely still in QT. I don't know when they're going to pivot out of QT. And again, to give you guys some more understanding of like what QT, QE is money printing. Government buying bonds, stimulating the economy. They do so to stimulate the economy when it needs it. In 2008, they did it, and it's mostly passive QE, which means they're not. It's mostly passive, but sometimes they do sell off bonds, and so it's a period in which quantitative tightening is the opposite of QE. So QE, they're buying bonds, they're expanding their balance sheet, they're trying to stimulate the economy. QE reduces QE basically stimulates the economy and lowers interest rates to consumers. So when 2008 happened and 2020 happened, interest rates were very low. But what happens when interest rates are low, again, going back to this, is that consumers tend to spend. One of the consequences of QE is inflation, right? Because the less people are paying for their mortgage just to focus on mortgages for a second, which is one of the interest rates affected by it, the less people pay for a mortgage, the more money they have to spend on nonsense. So prices go up in a lot of different things from quantitative easing, and quantitative tightening is essentially the opposite, right? Like tightening is when inflation is out of control. There'll be an QT period, and that's what we're in now. If that is the case, it means they think too much liquidation on the open market. I've got this feeling telling me that since everyone expects a dump upon Nvidia, alright, and Pawn, I'm gonna send you something, bro. Tell me what you think about this. Is Fed pivoting or staying on course with the rate pause? I think they're going to pause continuously until June, personally. I think they're going to continue pausing until June. I just don't think they're going to... It's too early. It's just simply too early, right? Like, of course, real estate professionals want lower interest rates, right? Like, they want lower interest rates. It's a lot easier to be a realtor and a mortgage broker if interest rates are low, right? So I think sometimes with confirmation bias, people expect the Fed to stop raising rates and pushing for a cooler economy. They expect the Fed to do that sooner than they need to. And I think right now, interest rates are still very high. Inflation is still high. And I think, because you got to understand, again, it all boils down to how much consumers are paying. If consumers are paying less in interest rates, they spend the money on other things. If the consumers are paying more in interest rates, they have less to spend, and that lowers inflation, right? When interest rates are higher, again, if I'm paying 8% in my mortgage, that mortgage payment's going to be a lot. It's going to be a much larger chunk of my overall earnings, thus not allowing me to spend as much money on other things and reducing inflation. That is the logic of quantitative tightening and rate hikes, a hawkish Fed, a contractionary monetary policy, right? It's all they're all trying to do things to the economy. They don't want it to get too out of control because that raises inflation. They don't want it to get too weak because that increases the chance of a recession, right? So it's all a balancing act by the Fed. And it's important, it's an important nuance. If you want to understand economics, it's an important nuance to pay attention to. The market now is not at all economic. Oh, it's not at all, right? Because again, in theory, quantitative tightening would push the stock market down, right? Like in theory, quantitative tightening would push the stock market down because people would have less money to spend on stocks, but that's not happening at all. The market has been ripping up, breaking highs. Quantitative tightening's been in full effect, and we don't know when that's going to stop. And so, sometimes economics isn't sensical, but on a macro sense, it is. So it takes time, but probability-wise, it is, I guess, is the easiest way to put it. But sometimes it doesn't always make sense. I like Sega. You know. Is there a live stream? There's not a stream for the Fed is not going to stream. There's no Fed meeting today. There's no Fed meeting today. Again, it's an FOMC Minutes report that breaks down why they chose to do what they did in the last meeting, is what it was. There's never a normal market. I've heard this is not a normal market since the 90s. That's mostly bears mad that we haven't bared, you know. That's mostly just bears upset that we haven't pulled back. And the market's been very strong over the last 25 years, even including the 2008 mortgage crisis in 2020. The market's still been incredibly strong when you look at it. Again, if we zoom out here, one of the reasons the stock market is a tried and true method of inflation hedging is because when you zoom out long term, you know, the gains in the market, again, if we look back at 1994, the S&P 500 was under $50. Today, it is 500. So, you know, the S&P 500 appreciates. Now, we might have little bubbles of weakness in 2008 and 2020, you know, in 2000 with the dot-com boom and crash and all that good stuff. But when you zoom out on a macro sense, it's pretty strong, of course. So yeah, there's no live stream from the Fed. It's instead a 12-page document detailing why they chose to make the decision they did in the last FOMC meeting. And we're going to break down that report. We're going to give you summary and cliff notes using AI, and we're going to watch the market reaction to it. Is what this is. It drops at 2 p.m. in 23 minutes. Let me put a timer up. I actually don't have a timer up yet. Yeah, the Fed likes PCE, which is the Personal Consumption Expenditure Index. It's a more true gauge of inflation, they say. And I think that drops next week for PCE data. I believe it's next week. I want to understand the report before anyone else. How do I do that? I mean, you could watch this stream. We're going to break it down very quickly. But, you know, before anybody else is all, you know, be best buds with Jerome Powell, you know. Gold 100% sell full margin. I don't know. Doubt today we're going to see a massive reaction. Yeah, I mean, Nvidia earnings are probably going to be the biggest reaction. We're going to stream that as well. The FOMC are reactionary. By the time they react, the damage is done. Inflation was not transitory. And if unemployment continues going up, they'll pivot late and the damage would be done. Just my 2 cents. Maybe. The Fed website, I'll put it up on screen. So again, here's... Actually, it's in the description. Look at the description if you want it. But here's the page, right? So here was the January Fed meeting. So here's the January Fed meeting. You can see the statement, the press conference if you want to watch a recap of it. The minutes report's going to show up here. So the minutes report will show up right there. And so at 2 p.m. it's going to be released. We'll break it down. Now, we use AI and we'll break it down pretty quickly. Just did the poll. Did the majority of people here still think they're going to cut rates in March? I personally don't. I think I don't understand. I mean, it's just so outside the realm of possibility. I think like real estate professionals want rate cuts to happen earlier. They want a more dovish Fed. They want quantitative tightening to end. They want interest rates to go down. But just because you want something doesn't make it true. I think you have to, again, we'll see what the Fed says in March. I do not believe we're going to cut rates in March personally. But I think anything could ultimately happen. I just don't think it's time yet. I think inflation's still out of control. And I think even if we do announce a rate cut in March, I don't think the market's going to react favorably to it. I think it's too early, you know. I think it's going to be June, personally. Yeah, there is no meeting today. It's a Fed meeting reaction to the last meeting they had. I'll put this up on screen so people can understand it. All right, so we put this up. FOMC Minutes report goes live at 2 p.m. It's not an actual press conference, and it's simply a reaction and a recap of the last meeting from January, just so people understand. Look at the description, Raphael. What's in the description, brother? It says federalreserve.gov/monetary policy/FOMC calendars is what it says. Let me see if this is it. Hold on. Yeah, this is it right here. Look at the it's literally the first link in the description. Brings you to this site. The minutes report will show up on the right side here. And again, we're gonna get it. Again, you can look at it yourself. We're gonna break it down quicker than you'll probably be able to look at it. We're gonna use AI and have that interpret it. So, CPI hot, PPI hot. Definitely no cuts until June. Yeah, I agree. Who knows though? You never know. Anything could ultimately happen. I don't personally think we're gonna start cutting rates, but again, anything could freaking happen here. Yeah, if they lower in March, it will be seen as too soon, so the economy must be in trouble and the markets will go down. Yeah, for sure. I agree. I think March is way too early. And again, I think you got to understand confirmation bias of a lot of people. Again, real estate professional, mortgage people, they want interest rates to go down, right? They want the Fed to start cutting rates. They want quantitative tightening to end. They want the Fed to stimulate the economy and lower interest rates so that mortgage rates can go down and that people will start buying houses. That's essentially what they want, right? Real estate, mortgage people, that's what they want. But just because you want something doesn't make it true, and you have to look at inflation. It's a balancing act with inflation and recession risks, right? Right now, inflation's still rampant, higher than expected. The market didn't like it. And again, it's a weird market because typically during quantitative tightening periods like we're in right now, where we have a hawkish Fed and a restrictive monetary policy is probably a more accurate stance than QT. But when we're in a restrictive monetary policy Fed, typically stocks don't always react favorably to that. Why? Because when interest rates are high, people aren't buying as much stuff. They're paying more in mortgage payments. They're paying more in everything. So they're typically not buying as many S&P 500 shares in that way, if that makes sense. So it's not always a period of goodness like we've had over the last year when quantitative tightening and a hawkish Fed is there. And so sometimes the market's nonsensical. I'm not sure when the Fed is going to stop selling bonds off, but they said 2025, late this year, maybe next year. So we'll see. If you want to know when interest rates are going down, that's probably my guess. Next, CPI will be telling for rate cuts. More important than CPI, PCE is the Fed's preferred inflation metric over CPI. CPI is more watched for retail, and we stream each CPI report. The last one, we got almost 30,000 views. But CPI is not what the Fed looks at the most, right? They look at PCE data, which is personal consumption expenditure. They're looking at businesses and how that gauges inflation in a more accurate way, I think, which is the PCE is a more accurate inflation gauge according to the Fed, right? So that'll be important, and that's next week, right? That's before the next rate hike decision. So that'll be an influence, I think, for sure. Only way to fix the housing market would be if real estate investors put their money in flipping commercial real estate to single-family houses. Well, yeah, they're already doing that. A lot of people are transitioning commercial to residential in unrestricted land, right? So that's already happening. Was the last meeting bullish or bearish? It was bearish, I believe. I believe it was a rate pause, hawkish Fed is what I remember than the last one. The Fed was certainly hawkish, if I remember correctly. He basically said that we're not out of the woods, that he didn't think we were going to cut rates in March. He said that wasn't their his exact words, I believe. Powell's words, was cutting rates in March is not our base case right now. Like, basically, they're not planning on cutting rates in March. Now, anything could change, and I don't think, considering that since then we've had higher inflation data, with CPI data coming in higher than expected, I just couldn't imagine that Powell is going to pivot to a cut after saying it wasn't their base case, and then inflation data coming in higher than expected, which is more so of an argument for not cutting rates, right? And so I think that's the nuance and the lens, I guess, you have to look at it under, in my opinion. But again, you never know, and anything could happen, and maybe the Fed does start cutting rates. I'm not sure. I'm not the Fed. I don't know what they're going to do. But if we go with what they said last time, I think that's kind of how you have to look at it, right? Catching back up on chat. Bro, tell me buy or sell. Dude, I'm the last person you want to tell you buy or sell, brother. I have no idea what anything's going to do. I don't try to predict what the market's going to do. I'm just going to react to it. I've sold off a lot of my positions personally, but I'm certainly not going to tell you what to do. Figure it out, you know. What do you think about commodities? Natty gas? I don't know. I'm not really a big natural gas trader, to be honest. I don't really mess with it. I hold some stock positions in oil companies, but like natty gas is always it's a niche of the market I just don't know that well. So I try to stick with what I know. Yeah, Bitcoin's gone crazy over the last couple days. Bitcoin down to almost 50K though. So, you know, Bitcoin ripped all the way up to almost 54,000 last week. Should I hold Nvidia? I'm not telling you to do that either. I think Nvidia is super high up there. Where's Nvidia at right now? So here's the Dixie on the right side. Here's Nvidia. Yeah, Nvidia's down. I don't know. This is a tough one. I think a lot of people are going to argue Nvidia is up so much, but their earnings are today as well, and anything can happen with earnings. Personally, I think that they're extended on the upside, and even if they come in really good for earnings, I think the extension's on the upside. I'm not saying we're going to pull back. I'm just not confident enough to buy more shares up here. I think we're too high for that. And I hope it goes up. Nvidia's kind of been, influencing the whole market over the last year. And so I hope it goes up because that means the market goes up, my investments move up. But still, it doesn't mean I think it's the most likely, the most probable thing. What's an opinion, dude? I don't even know what an opinion is, sir. I wouldn't trade Nvidia until after Nvidia earnings. Yeah, I mean, listen, guys. I think you might be able to find somebody that are going to tell you to buy or sell things. Typically, I think the Dunning-Kruger effect rings very true to markets, which means that the less somebody's been around, the more they think they know, the more confident they are in giving out those type of predictions. The longer somebody's been around, the less they recognize, they understand, and know, and so the less likely they are to give you those big, bold predictions, And so if you're on somebody asking some random YouTuber whether to buy or sell a security, you're probably very, very new, and that's not what you want to do. You want to just research it yourself. You're going to be your own best advocate there, not me. Too many people are biased by their own positions. If I buy up a bunch of Apple shares, of course, I'm going to say Apple's the greatest stock ever. But there's bias there, so you just got to be smart. Hey, what's up, Jay? Earnings doesn't mean anything. They own 90% market share of our AI chips. Nvidia will rip. I hope so. Listen, I really do. I hope they go up. All right, we got about 1,200 people here live. We still got 10 minutes until this report drops. Facts. Took me 4 years of market time to learn it. You just got so many market gurus trying to slang courses at you, trying to sell mentorship programs. I'd rather just be like, yo, I have no idea what I'm talking about. And if people think I'm still good, fine. But, if not, they can't get mad at me if I lose money or they lose money or whatever it is. You're right. These notes are retrospect, but we know they know. Wait, chat's moving too quickly. Inflation is being sticky. Not sure why Powell was so dovish after the meeting. I don't think he was dovish last meeting necessarily. I think he was pretty hawkish. I think a lot of people thought we were for sure in a soft landing situation and that the Fed was going to be dovish moving forward. But I think Powell reinforced the pause and hawkish stance. in the last FOMC meeting. So I don't think he was necessarily dovish. It's a little ambiguous, of course, but like I don't think he was super dovish personally. I know he said the Fed's gonna stop unloading their balance sheet sometime over the next year or two. So we'll see when that happens and quantitative tightening stops. Tesla almost at the 194 level. Yeah, I got you guys. I'm going to give you guys cliff notes. The real gauge is watch the market. These bots are going to pick this stuff up so quickly, faster than me even. And so they're going to make trades based off of what they think the outcome of this report's going to be. And so that's something that you want to watch, right? Like imagine you have a pretty good supply of money, right? You could build an algorithm that interprets and researches this report in about 5 seconds, picks out whether the market's going to interpret it as bullish or bearish, and takes the appropriate positions based off of it. You have algorithms like that in the market for sure. And so watch the initial reaction to the report. We're going to detail the report, talk about it, break it down, give you cliff notes, all that good stuff. We're going to do all that stuff here. You won't have to go anywhere, and it'll probably be faster than you doing it yourself. But just watch the market reaction to it also. That's going to be an important gauge of what happens as well. Sometimes the first reaction's not always the best one, though, so just be careful. I don't know how big of an impact this report's going to be. I think Nvidia is going to be a much more impactful thing for markets today, which is going to be after the closing bell. We're streaming the entire Nvidia report, earnings call, all that good stuff live here like we always do. But yeah, I think Nvidia is going to be a bigger release than this. Will the Fed be hawkish or dovish in this report? Let me know in chat right now. Dovish is when JP said things are looking great. We may be able to cut. Hawkish is inflation sticky. We have to maintain. Even raises not off the table. Yeah, I think him saying March and even March and May were not base case rate cut periods. It was pretty hawkish. But again, you know, maybe we do cut in March. I don't know. Hawkish, dovish, hawkish, hawkish, neutral, hawkish, hawkish. It will hurt lending. Yeah. Hawkish, hawkish. Short Bitcoin 100x. This usually is a mirror movement from the meeting. I think I'm trying to remember what we did during the last meeting. Let me look it up real quick. The last meeting was January 31st, right? So let's take a look at this. 90 days. We'll look at a 15-minute chart. All right, so here's the last meeting right here. So yeah, here's the last meeting right here. So yeah, the market definitely reacted negatively from the last report. So again, here's the last meeting right here. Here's the FOMC. We pushed up to 489s in the SPY, and then we dumped down for the rest of the day. We started to rebound the next morning and extended hours in pre-market though. But we ended the day down. Didn't reach back up to where we were prior before the next day at the closing bell. So definitely a hawkish reaction to the report. Although if we're looking at delayed responses, of course, the market ended up flying up afterwards. So up in the air, I guess. Easiest way to put it. All right, guys. Hey, we got 6 minutes. 6 minutes until this report drops. That's why I'm pausing trading today until I understand the report. I would wait for Nvidia too. I would be very careful not to take any big size positions unless you're okay with losing or being... I would just be careful. Anyone know where I can watch the FOMC Minutes live? It's not a conference. It's a reaction to the last press conference, brother. Read right here. Let me fix this. Read this right here. Nvidia drops after the close. We're going to stream that as well. Again, hit the live button next to the play button. Make sure you're fully caught up on stream. We appreciate it. Maybe dovish, but that was before inflation data scared the market. Yeah, I guess. All right, guys. Hey, we got 5 minutes. 5 minutes. Do big, powerful traders get these reports earlier than us? Unless you're talking about members of the FOMC, no. Hawkish just priced in. Watch for dovish reaction. Maybe. Again, I'm not one of those people that give you some big, bold prediction. I think that's mostly to the gurus out here trying to sell you stuff. We'll see. Okay, good luck, Robert. No, Sir Burns. You can't. Sorry. Too hard for me to vet. Too many people trying to plug their own stuff. I can't vet them. So please don't. Nvidia is the key to push market up or down, not the FOMC minute. Yeah, I mean, again, I've said that many times. The Nvidia report is going to be much more impactful, in my opinion, but maybe I'm wrong. I don't know. Mortgage rates went over 7% again. Mortgage apps went down 10%. Used vehicle inventory spiked super high. Yeah, I mean, again, we're certainly feeling the hawkish Fed. You know, the quantitative tightening's in full effect. They sold bonds this morning, or recently they did a bond auction. I mean, so... yeah, I mean, the Fed's certainly hawkish, still pausing, quantitative tightening, you know, high interest rates. Who knows when they're going to come down? Just depends on when the Fed changes their tune. Again, there's not a press conference. Please tell about gold. Gold's sitting at 2030s. If you look at gold over the last 10 days, it's mostly flat but slightly red. Can someone get rid of these spammers? Yeah, I mean, I think people are just, there's 2,100 people here live, so I think you just get a lot of people. And the report's about to drop, so people are more active. There's no press conference. It is a reaction to the last Fed meeting, is what it is. It's a Fed meeting reaction. That's what the Fed Minutes report is. It's a reaction or recap of the last Fed meeting. All right, guys. Hey, we got 2.5 minutes. 2.5 minutes. Hit the live button next to the play button. Yeah, if you spam, you're going to get banned. All right. Here we go. All right, guys. We got 2 minutes. Let me take my sweater off. It's hot. It's getting hot in here, you know. All right, guys, we got 2,300 people here. Hit the live button, hit the subscribe button. I appreciate it. Again, you don't have to open the Fed's website. We're gonna cover it probably faster than that anyway. So you don't have to open up the Fed site. We're gonna cover it probably quicker than all that stuff, anyways. Chat. So let's get ready. We got 2 minutes. 2 minutes. Again, we're gonna cover this faster than you doing it yourself, just to give you a heads up. What to do with the NASDAQ? I don't know. I would just be very risk averse right now. 1.5 minutes, team. 1.5 minutes. Guys, it's not a conference, it's a sheet of paper. Well, yeah, I guess. Two more minutes. All right, we got 1 minute, 10 seconds. Hit the live button next to the play button. You want to make sure your live button is nice and red. You want to make sure your live button looks like this. Nice and red. If it's white, you're delayed. Hit the live button next to the play button. Make sure you're called back up. Yeah, so is money. I like that one. All right, team. You guys ready? We got our page live here. We're going to wait for this report. Let's get ready. 20 seconds. 20 seconds. We've got our AI ready to interpret this for you. 30 seconds. 30 seconds. Here we go. 15 seconds. 10 seconds. All right, here's the report. Let's watch the market reaction. There's the SPY. All right, so the report is now live. Let's zoom in a little bit here. All right, so market has reacted negatively so far to this. Now it's back up a little bit. All right, let's get the report. Let's get the report. Let's find it. Waiting for the report to show up. We gotta wait for it to show up right here on the right side. I'll let you guys know when it's here. Waiting. Waiting. All right, Fed is a little slow. Market so far has negatively reacted to this. Negatively reacted. Markets are starting to go down. Let's see. All right, market's negatively dropping down a little bit here. Hey, I see somebody sharing my stream. I appreciate it. Waiting for this report to pop up on screen. Sometimes they're a little late. I think it's here now. No? Market's down a little bit. Let's give you guys some recaps here real quick. Most policymakers noted risks of easing too quickly, emphasized the importance of incoming data in judging if inflation is moving sustainably to 2%. So here's the first Cliff Note breakdown. Again, FOMC Minutes, most policymakers noted risks of easing too quickly, emphasized the importance of incoming data in judging inflation is moving sustainably to 2%. All right, so that's a hawkish take. That's a hawkish take for sure. Hawkish take for sure. That's probably what dipped markets down. So again, it's a hawkish take for sure. That's mostly what pushed markets down a little bit. The Minutes report is live. I'm going to give you guys the link of this report if you guys want to see it. But again, give me a second. We're going to continue giving you guys cliff notes of this report. All right. So again, let me give you guys some cliff notes here. I'm going to move to developments in financial markets and open market operations. All right. So here we're gonna give you guys some. All right, so during the intermeeting period, financial market experienced modest easing in conditions, but remained relatively tight compared to previous periods. Declines in nominal treasury yields, particularly on front end of the yield curve, were attributed mainly to lower expected policy rates, with inflation expectations remaining stable. Equities reached new highs driven by large cap tech companies through broader valuations were more subdued. Market expectations regarding monetary policy suggested increased likelihood of earlier rate cuts. And so here, influenced by recent inflation data and economic projections. All right, so here's part of the summary. Again, this is actually a dovish thing. Market expectations regarding monetary policy suggested increased likelihood of earlier rate cuts influenced by recent inflation data and economic projections. Market attention focused on potential slowdown of balance sheet runoff, which is, again, a slowdown of quantitative tightening with expectations for a start by July. So they expect potential to stop this quantitative tightening period by July or slow it down. Money market indicators indicated abundant reserves with on RP or RRP facility usage declining. All right, so markets are actually ripping up on this. Again, I think some of this data signaled a more dovish Fed. So again, I think some of this signaled a more dovish Fed. We're going to keep breaking this down. We're going to look at the staff review of the economic situation real quick. We're going to give you a breakdown of that. All right, so economic-wise, all right, so as of the January 30th to 31st meeting, GDP growth slowed from the third quarter, labor market conditions eased, and inflation declined but remained above 2%. Foreign economies faced challenges with subdued growth in advanced economies and varying inflation declines. Most major central banks maintained unchanged policy rates, so most basically paused. All right, so let's look at staff review of the financial situation. All right, so we're giving you very quick recaps of all this stuff. And again, we're going to look at the outlook. Okay, so we're going to do a quick recap of all this stuff. Over the intermediate period, Treasury yields and expected funds rates, federal funds rate passed decline, suggesting less restrictive monetary policy expectations. Look at the market rip up. Financial conditions and borrowing costs eased slightly, but remained moderately restrictive. Short-term funding markets remained stable. Credit availability persisted, but standards tightened, particularly for commercial and real estate loans. So again, a more dovish outlook, I would say here. We can look at the staff economic outlook here as well. The staff's January economic forecast was slightly stronger than December's, with upward revisions to GDP growth. Tight financial conditions were expected to constrain growth this year and next year, aligning with potential growth in 2026. Inflation was projected to decline, with risks tilted slightly towards higher inflation and downside risks to economic activity due to potential financial tightening and household financial strain. Participants' view on current conditions in the economic outlook. I'm sorry, baby. I'm in the middle of doing something. I can't. All right. Participant views on current conditions and economic outlook is the next thing we're going to look at. All right. So again, we're trying to summarize all of this stuff. We're going to look at the participants' view on current conditions and economic outlook, which is a very long aspect of this. Maybe the most important aspect of this. So again, let's take a look. Participants noted solid economic expansion with GDP growth above 3% in quarter four, driven by consumption and favorable supply conditions. Inflation remained above 2%, prompting concerns about its impact on households. Labor markets tightening persisted, though job gains moderated. Risks to the economic outlook were balanced, but uncertainties remained. So again, we're kind of detailing all this stuff. There's a lot more to look at. We got policy actions. And yeah, that's what I got so far. We'll wait for other cliff notes here as well. So we'll look for other cliff notes as well. Markets are pretty much flat from this so far. Let me see if we can find some other cliff notes. So that's my cliff notes from this report. Again, I would say a little bit more dovish than anticipated. Now this doesn't really mean anything with Nvidia earnings coming out. Doesn't mean that much. But yeah. The interesting part is okay, so when does quantitative tightening stop? Right? That's the question. What is here, I'm going to give you guys a link to this if you haven't found it yet. This is this report right here. I'll put the link up. Again, when the economy is thriving, inflation tends to get worse. So when the Fed does quantitative easing, it's usually because the economy needs help with money printing, buying bonds, and all that good stuff, brings interest rates down. That gives your average consumer more room to breathe in terms of their expenses month to month. If your mortgage interest is lower, you typically have more money to spend, and that helps stimulate the economy, right? But one of the consequences is inflation. So there's periods of quantitative easing and quantitative tightening. Quantitative tightening means quantitative easing means money printing, buying bonds, and expanding balance sheet by the Fed. Basically, the Fed pushing for a thriving economy. And quantitative tightening is the opposite of that. It means the Fed stops buying bonds if it's passive QT, or they sell bonds directly with direct QT. And their goal is to limit inflation, to lower inflation, to stop the economy from growing too much, because ultimately prices are going up too much, right? So that's periods of what we've seen over the last few years with quantitative easing during 2020, and with interest rates going down, and then inflation getting out of control, prices for everything increasing. Inflation was almost at 9%, a year or two ago. And so the Fed's been in this QT, this quantitative tightening period, where they're unloading their balance sheet. And so again, the question is, when are we going to start? When are we going to slow that quantitative tightening down? Again, the sooner that happens, the lower interest rates can become. So if you want to know when interest rates are going to potentially go down, that's what we're looking at, is what the Fed's going to do in that regard. So yeah, looking at the chat, it's chaos right now. We got 4,300 people here live. A lot of people wanting gold information. Gold is sitting at 2030 still, basically unchanged. The SPY is moving up. It's at 495s right now, 495s. And again, if you haven't already, if you want to day trade with no PDT rule, the futures market is probably what you want to do. We've been looking at the SPY, but if I look at the E-mini, it's the same price action as the SPY, but I can day trade this right side here, and if I zoom in, you'll see it's literally the same thing. Same price action at least. I can day trade this right side here with no PDT rule, instant settlement in futures, right? The futures markets, you can day trade, short, buy market, sell market, all that good stuff in futures, no PDT restrictions. Top Step is the most legit funded program in futures. And listen, most day traders lose money. And so if you want to learn to day trade, do not put the money up yourself. Of course, I'm biased because they pay me money and they're a sponsor of mine. And again, you want to understand this rule right here. But remember, most day traders lose money. And so you can either put up thousands of dollars yourself trying to day trade and lose thousands of dollars. Most day traders lose their first few accounts at least. It's kind of a rite of passage. Or you could try a funded account program. What they do is they give you a demo and they test your skill. You still have some pressure to succeed, not the full extent of risking thousands, but some teaches you how to trade under pressure. And if you're good enough to pass it, they fund you between 50 to 150,000 with a 90% split. And so if you get funded and you make 20K, you get to keep your first 10K in profit, and then you get 90% after that. And the best part is that most day traders lose. So if you lose this, you're only out what you pay for it. The base one's only $50. And so it's not the end of the world. It's the best of both worlds. It's a great way to limit your risk in day trading. And so instead of risking thousands of dollars, try a funded account program. It'll probably save you money even if you lose there. It's just a lot cheaper, a lot lower risk than putting up thousands of dollars yourself in markets. And you can check it out here. You can day trade the S&P, the NASDAQ, essentially the QQQ in futures. No PDT rule. You can trade gold for all the gold traders here. You can trade gold, some currencies, cattle prices, whatever you want to trade, you can trade for the most part there, except for stocks. You can't trade stocks, but commodity-wise, you can trade whatever. You can check out the link right there. They are a sponsor of mine. There's the link for the FOMC Minutes report. If you want to check out Top Step, here's the link. Again, they are a sponsor of mine. I am biased, of course, in their favor because they pay me money. But check them out right there. They're a sponsor. Check them out. I'm running out of breath here, team. When is Nvidia? Nvidia earnings are after the closing bell today. So they are in an hour and a half. And we're going to pivot to Nvidia earnings soon. I recommend Top Step. They're a sponsor of mine, so of course I'm biased, but you can check them out right there. All right, again, the FOMC Minutes report is out. The market is mostly stagnant from it. It hasn't really reacted majorly from it. We are green in equities today, so that's good. I guess let's get some day trading out here. We're going to day trade today, too. We're going to try to day trade gold. I've never day traded gold before. And so we're going to play around with gold on our funded account program here. Is the Fed minutes positive? I'm not sure. I thought it was a little bit more dovish than previously anticipated. I think they were talking about, ending QT earlier than I originally thought. I think they saw optimistic things, earlier rate cuts. That's what I read a lot with the summaries in the cliff notes. And so I thought it wasn't bad personally. But, again, market's the market. We don't know, what they're going to react to or how they're going to interpret things. It sounded hawkish to me. I tend to be a little bit more hawkish than a lot of people. Again, I think interest rates, I'm not in the market to buy a house right now. And so I don't really care how high interest rates are right now, to be honest. I'm a real estate agent, but I don't really do that much business in real estate. I don't really focus on it like that. But I'm okay with the Fed taking a little bit longer to make sure inflation is less sticky and more under control before they start going dovish and cutting rates and ending QT. I'm okay with a little bit more of a sustained period of them getting inflation under control before they cut. And again, it's a tricky balance because if you cut rates too soon, inflation can get worse. If you cut rates too late, then recession fears and it could crash the economy essentially. So it's a balancing act. But it's something that you want to pay attention to. Yeah, I think June is probably where we're going to cut rates, but I'm not sure. Every time the market goes in a bloody red and everybody's screaming. Yeah, there's a very famous quote. It says something along the lines of, the time to buy is when blood is running in the streets. Very famous quote. I think it might have been Rockefeller. I can't remember who said it. But no, honestly, I'm the type of person where I look for really weak markets and I buy blue chip legacy companies. A lot of people lose money on mid caps and these speculative companies that are brand new, that have only been around for a couple years. I try to buy companies that have been around for at least 5 to 10 years, at least, and that are well-known blue chips. I buy those when they're weak. I think that's the safest bet if you're looking kind of in dip buyers, bottom feeding dips. That's kind of what I like to do. But you can't do it all the time, and you got to be careful with those as well. When did they decide to stop QT? Well, they said July, I believe, is something I read in this report. They said they're looking at July for the Fed to stop limiting its balance sheet. And so maybe that's when they do QT or they end it. I'm not sure. It'll probably be a transition, though. Market selling off. Yeah, market starting to dip. Very flat reaction to this. Again, what's going to be the most important thing today, team, is the Nvidia earnings. That's going to be single-handedly the biggest report we got today. Almost certainly. The minutes report is just a reaction to the last Fed meeting. And so, you know, the minutes report is big and all, but the Nvidia report, Nvidia has single-handedly propped up the S&P 500 over the last year straight. The PE ratio is super high. Nvidia has reached almost $1,000 in price. You know, got up to $800. It's currently at 670s. Nvidia earnings have the chance to shock the market, and in a good way, in a bad way. Typically, I'm a little bit more bearish right now. I sold a lot of my positions over the last few weeks in anticipation for today because I'm kind of nervous about what the market's going to do. I've made a bunch of money this year already, and I don't want to be greedy, and so I took some profit. Still holding, let me see, my position currently is about $9,500 in portfolio. So I'm holding about 10,000 in portfolios, which is a small amount for me personally. Usually I'm holding much more than that. But right now it's very light because I just don't trust the market right now. I think the market's up a ton. I think tech has increased rapidly. And I think, you know, Nvidia earnings are one of those earnings where it could go really well. It could also go really poorly. And so I'd rather avoid that risk. And if we dip a lot, maybe I'll buy it. Is Nvidia correlated with Supermicro? I'm assuming you mean SMCI. Yeah, they're both microchip companies. Supermicro is crazy, though. Chaotic. I can't justify buying it. It's just too high. I mean, it's pulled back some, maybe. Now it's not as bad, I guess. But it hit over 1,000. I just can't buy that, man. It's too freaking high. So much risk involved in this. Like, this thing can drop 25% overnight. I'm not trying to play with that. That's just too much risk. All right, so let me go ahead and day trade some gold here if we can. Let's play with it. Again, this is a combine account, so this is not... let me see. What is it on? Is it GCH4? What's the symbol on Quant Tower? Somebody give me a more volatile gold futures. Here's GC. I don't like this. This is too little liquidity. What's a better liquid, a more liquid gold price to day trade? S&P 500 now back over the 200 EMA VWAP level. You can't be live. You lagging? Hit the live button, Gap. Hit the live button next to the play button. You're probably just delayed, bro. Well, yeah, they're both correlated. They're both microchip stocks. Yeah, Nvidia report is going to certainly, not certainly, but almost certainly affect other tech stocks for sure. Just because Nvidia price action has increased prices of other tech stocks for sure. Maybe it's all just the AI sector as a whole, but yeah, there's going to be some sympathy movement. My name is John, Sir Burns. GCJ24. Let me try that. No. Let me look at GC. So here's GC. Gold is GC, right? I'm looking at GCJ. Sounds like 3-6 Mafia. Okay. Let me see if we can day trade this. Okay, there we go. That's what it is. GCJ4 is a good gold ETF. I'm not really super used to this. I don't know if I want to short it or go long here. Let me look at the chart. I guess I'm going to short it for a second. We'll see how it responds to that. All right, so this thing has, I don't know if it has $20 a tick movement or what, but we're in gold right now. We're short. Maybe $10 per tick movement is what it looks like. I think it's got to be a little bit longer term as a trade. Oh, the market can certainly do anything. My name is John, everybody at home. All right, so we're up $30 trading gold. We've already green a little bit in this account. I'm going to give it some time, see if we break down a little bit more before we take profit. We're up 20. Yeah, I think Nvidia is going to be the biggest influence today on things. Almost certainly. All right, we're up $40 in gold. Day trading gold futures. Up $50. Do I want to add size to this? We're already up a little bit on the day, I think, right? Yeah, we're up $100 on the day pre this trade. Telling short about Fed minutes. Yeah, we've already given our recap of it. Again, what I'm seeing so far from the Fed is that most policymakers noted risks of easing too quickly and emphasized the importance of incoming data and judging if inflation is moving sustainably to 2%. Basically, what you want to understand here is that we're going to be watching PCE data heavily, right? We're going to be watching PCE. I'm going to add a little bit more size to this. We got 2 contracts of gold here. But we got to watch PCE data next week heavily. Inflation data is incredibly relevant. Specifically, PCE is the most used inflation gauge by the Fed, right? So the Fed looks at PCE data, which is next week. So next week, we're going to pay attention to PCE. I believe it drops Thursday of next week. It's going to be a huge gauge on markets for sure. Very big gauge on markets. How about gold? I'm shorting gold right now, but we're just playing with house money. We're already up $100 on the day in this combine account. This is me trying to get funded in this account. We're already funded on a couple different accounts here as well, though. But we are shorting gold right now. And again, Nvidia earnings come out. We're going to start, Nvidia earnings come out soon too. So we're going to be covering that as well. We're going to stream the entire thing, the entire press conference, all of that stuff live as soon as it drops. So be ready for that as well, team. All right, so we're slightly green on gold, shorting it. All right, so the SPY break it down. Gold should follow it. A lot of the time, gold and the SPY move positive correlation with each other, so we're gonna see if gold follows it. We're trading gold futures. Again, remember, I tended to be more bearish ahead of this report. I think the market's just up so much, and extension is such a huge thing you want to pay attention to. Like, regardless of how bullish or bearish you are about any specific earnings report, any specific economic report, you have to consider extension in markets. It's a technical factor that you always want to pay attention to because extension is important. It's very real. And again, my bias typically falls on the upside long term, of course. Like, stocks are going to move up long term. It's an inevitability for the most part. But short term, anything could happen, and so I think the market's just up a little bit too much short term to not correct at least a little bit. It's one of the reasons I sold off a lot of my portfolio over the last few weeks. But again, Nvidia earnings could come out and the market could skyrocket up. I really have no idea. I hope it goes up too. I hope I'm wrong here personally, because I'm still holding some things, just not enough to be any significant hurt pain if it crashes the market. Please stop spamming here, guys. Saying the same thing over and over again every, 20 seconds. Come on now. I know we got some gold traders here, Matt. I'm shorting it. I'm shorting it short term. So I'm holding gold long term. I'm shorting it short term. I'm scalping it on the short side. Again, I'm buying it on the long side, and I hope gold goes up. I think gold is one of the best inflation hedges long term you could ever get into. Gold has 7x'd since 2000. 7x'd. It's gone up 7 times its value since 2000. Right? So gold is one of the best inflation hedges in the market. But short term, I'm shorting it just for technical purposes. I could go long. Maybe I'm going to pay for it too, because gold seems to be ripping up. Very flat though, but yeah. The rest of the market's dumping down too. We'll see if gold follows it. The SPY just cracked lows on the day, broke down under 494.40s. You are bearish for March. I don't know if I'd call myself bearish. I don't think we're going to cut rates in March, whatever that means. You know, I'm more hawkish, I should say, for March. I don't think we're going to start cutting rates in March, at least. I'm going to cut this. This looks too strong. So we're going to sell this and be about flat on the day and figure it out. We're also going to day trade the NASDAQ, which is breaking down a lot more cleanly, that I could probably capitalize a little bit better on. All right, so here's the NASDAQ 100, basically the QQQ price action. We're getting a lot of weakness showing up. I'm going to look for a little bounce and then short that. I think we're dropping a little bit too much short term for me to just jump right in short now. But if we get a small bounce up to here maybe, or here, I'll short that. Well, I just watched an interview. All right, so we're in one contract here, short. We're shorting the NASDAQ 100 now. We're up 30. Let's flush. All right, so we just made about $80 shorting the NASDAQ 100. We'll see if we get some better price action now too. This is Quant Tower. I'm on a Top Step. Top Step is a funded program in futures. So I'm already funded in a couple accounts, but this is a combine account, like me trying to get funded in one. But I have a couple already funded accounts. We're going to short this as well. And we got a cushion on the day now, so we can take a little bit larger size now that we have that cushion. What Top Step does is they give you a demo, and they test your skill with the demo account. And if you can pass the test, they fund you. If you can't pass the test, you're only out what you pay for the combine. We're going to take half off there, lock it in, see if we get a larger breakdown. Flat on the rest. Good thing we cut a piece of that. We're kind of flat now on it. Could add to this, I guess, but that's a big rebound in markets, especially with Nvidia earnings come out. I'm a little hesitant to take larger term trades, but we'll try one addition to it. Very volatile time, so you just got to be really careful in markets like this, because anything can freaking happen. But yeah, what Top Step does is they give you a demo and they test your skill, and it limits your risk in the beginning. Instead of putting up thousands of dollars trying to look cool, you can only risk what you're paying for the combine, which in this case is $50, right? So if I lose this whole account, I'm only out $50. It's not the end of the world. Where if I pass this test, I get funded between 50 and 150,000 with a 90% split, right? So my risk is limited, but if I pass it, my reward's very good. I'm still keeping 90% once I'm funded anyway. So it's kind of the best of both worlds. All right, we just locked in a little bit more. We're going to cut that as well. So yeah, you can see we're up about 180 doing this. And again, if you want to check it out, they are a sponsor of mine. Of course, I always try to put this up a couple times. Remember, I am terrible at this stuff and have no idea what I'm talking about. Might be wildly wrong about anything and everything I say, and these are sponsors of mine, so you want to confirm with them to be safe and be sure. Again, you can check out the link right here if you want to check them out. Again, guys, a lot of people are confused about what the Fed minutes are. The Fed minutes report is a reaction to the last Fed press conference. So the last Fed press conference was in January, at the end of January. They did a press conference. Basically what happens, every 6 weeks, the Fed makes a decision for monetary policy, whether they want to raise rates if inflation is rampant and out of control, whether they want to pause interest rates if we're somewhere in the middle, or whether they want to cut rates if they're more dovish and we have inflation under control and we want more thriving economy, right? So they make that decision every 6 weeks. Weeks after that report, so the last one was at the end of January. Weeks after that report, they have what's called the Fed Minutes Report. It's a 12-page document detailing why the Fed chose to make the decision that they did in the last meeting, as well as give some foresight into what they might potentially do in the upcoming meetings for the year. Right? This is the recap. This is a recap, a reaction to the last Fed meeting. That's what this report is. It's a 12-page document. You can find the link that the page is on in the description. We also gave Cliff Notes when it came out at 2 p.m. So the report's already out. Again, if you want the actual minutes report for today, I'll put the link up in the chat real quick. Let me see. So here's the minutes report. There's the minutes report right there. The Fed paused. Again, another one of my sponsors is a company called Chart Prime. It's a trading view service you can use in stocks, crypto, forex, futures. Really useful. And again, I use this with my trading a ton. It's just a powerful service because, again, they give you kind of these signals. I can't guarantee you're going to make money with these signals. Nobody can. Remember, I'm not an investment professional, and I'm certainly biased in their favor as well because they're a sponsor of mine. But, I mean, I always challenge people to backtest this yourself. Right, so we looked at a 5-minute chart, like backtest it yourself. They're not always going to work. You're going to have to isolate times when it works and doesn't work. But like, check it out. Like, let's backtest it here. Strong signal there, nice little drops. Buy signal there, nice little bounce. Although you could call this one not working. I would say it depends on where it showed up. Strong signal there, definitely worked. Strong buy signal there, definitely worked. These two didn't work. All right, so for today, it's kind of choppy and flat. But let's see, we had 3 that didn't work up till there. Let's keep going. Strong signal, that worked. This one definitely worked. That one definitely worked. That one didn't work. So that's 4. That one worked. 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 This one didn't work. That's 5. That one worked. So again, 5 out of, let's count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. So 5 out of 19 didn't work. All right, so that is 14 out of 19. What percentage is that? That's roughly 75% accurate. I looked at a 1-minute chart as well. I can't guarantee it's going to work. Test it yourself. Make sure you're doing it right. I looked at a 1-minute chart earlier, and the 1-minute chart was actually impressive too. Let's see what they look like. So yeah, a 1-minute time frame. So this is more for like day trading, scalping. Look at this, strong signal, beautiful breakdown. Buy signal worked, strong signal, you got a breakdown from it. This one worked too. This one, we got a breakdown from it as well. Buy signal worked, sell signal worked. I think the strong one, or the 1-minute one, is even more impressive. I think almost all of these worked. I can't see any of them that maybe didn't work. Maybe this one right here. Maybe this one. I think the rest of them worked. So out of, let's see, maybe 1 out of 1, 2, 3, 4, 5, 6, 7, 8, 9. 1 out of 9. So close to 90%. I can't guarantee it's going to be that. Test it yourself. You can also, if you're a long-term trader as well, and you want to look at like an hourly chart. This is where every candlestick represents an hour. Let's test it. Again, look at the sell signal that showed up hours and hours ago. This one's actually pretty impressive. Look, sell signal, drops for hours. If you want longer term movements, strong buy signal. Just to put this into perspective, this time period is almost 3 days. Or no, this time period is 1 day actually. So still a day of appropriate action afterwards. This one probably didn't work. Buy signal, that one worked. Sell signal worked. Look at the hourly chart. It's genuinely impressive. Look at the huge follow through. So out of 1, 2, 3, 4, 5, 6, one of these, arguably one of these didn't work. I think the rest of them are pretty clear that it works. So if you like longer term as well, it's called Chart Prime, trading view service you can use in stocks, crypto, forex, futures. Again, check with them. Make sure it works for you. You should be able to get it for only $40 if you use my link. I think it's around $40. But again, they're a sponsor of mine. I'm biased, of course. You can check them out here. NASDAQ ripping up. So there wasn't any Fed meeting. This was a reaction to the previous Fed meeting. The ones that I was looking at don't repaint at least. The link is in the chat if you scroll up, as well as in the description. All right, guys. So the next thing we have is Nvidia earnings. Nvidia coming out pretty soon with their earnings report. We've day traded a bunch already. Gold did rip up. I should have bought gold. I think y'all are right. Gold moving up to 2030s. Huge pop up in gold, well over the previous closing price. Top Step X is probably the best platform, unique, but I love using Quant Tower. It just depends on which one's for you. I'm using Quant Tower right now when you see me day trading on there. So that's the one I'm personally using currently. Yeah, catching back up on the chat. With so many people here, the streams get crazy. Use the link in the description if you want to check it out. It's called Chart Prime. The link is in the description. The one I'm using on Chart Prime, I think it's called the Market Oracle Pro is what I'm using. And again, that's just a small piece. There's a bunch of other stuff that they offer. So like, check it out. Look, they have back testers, oscillators, screeners, all that cool stuff. Again, I can't guarantee you're going to make money. Test it out yourself. Not an investment professional. They're a sponsor of mine. They pay me money. I'm biased, of course. Yeah, Nvidia earnings are going to be chaos, though. I think Nvidia earnings are going to be a much stronger reaction versus this, in my opinion. Right, Nvidia earnings are going to be chaotic, I think, right? It's going to be crazy for Nvidia earnings. How much do I have to pay you to trade me? You seem to be the only legit trader online. I'm not. I'm terrible at trading. Don't copy me. Not an investment professional. And you couldn't... Again, I'm not guaranteeing to be anything. I'm not guaranteeing to be profitable. I'm not even claiming to be a good trader. I am not an investment professional. I certainly don't want people looking at me like I'm a day trading guru, because I'm not. Yeah. I mean, I'm green on the year. I was green last year as well. Investing, swing trading, some day trading, right? But yeah, I'm certainly not a mentor by any means. We provide free economic reports and understanding data, you know. What type of catalyst does the market need to recover? Recover from what? I mean, the market's down a little bit, right? But if you put up and again, bears are going to act like this is some doom and gloom scenario, of course. But if you pull up a weekly chart, I mean, here's the market over the last few years. Here's the market. This is the pullback we've gotten over the last couple days. You know, so I mean, I think Nvidia earnings have the potential to shock the market, though. So it's certainly something you want to watch, and we're going to stream the entire thing. None of it's forward-looking statements. Don't sue me. Not an investment professional. Not liable if you lose. Figure it out yourself. Do you only trade stocks? No, we trade futures. Today, in the last 30 minutes, we've traded stocks, gold, and futures. And the NASDAQ 100 futures contract, I mean. As a lawyer, that's a good answer. I think that's the point, you know. I'd rather... Look... I'm not claiming to be anything. I would rather tell people I'm not an investment professional. I'm not liable. I'm not a good trader. I'm not an expert. I don't sell a course. I don't sell a service for my own call outs or picks. People ask me all the time what things are going to do, and my most common answer is I have no idea. I think there's too many people that are out here trying to be trading mentors. And I'm not, there's some really talented traders out there. I'm not knocking any of them. But I'd rather be honest with people and tell them that I'm not an expert and just sleep well at night than trying to tell them I'm some super expert guru trader by my course and my signals and all this stuff, you know. We got other companies for that. Like, we have sponsors and stuff. But personally, as a trader, you know, I'm all right. I'm either the best decision you ever made in your life or the worst. And yes, that is an Office reference, okay, if you're thinking there right now. Yep. Not a doom and gloom. I don't know. You talk a lot? I mean, listen. If there were other people here, I would let them talk, I'm sure. I definitely talk more than anybody in the world. Definitely top 3 most talkative traders ever. But yeah. If that signal things works, why don't you use it? I have 4 monitors that y'all can't see. Talk all you like on your own channel. Yeah, for sure. People get weird, bro. Like, one thing you notice on the internet, people get weird. It's all good. Like I said, I'm very blessed. We still got 1,500 people here live. So, hey. Where's SoFi at right now? I bought SoFi a couple weeks ago, and it's down. It's okay. We're slightly red on the day. Again, it's been a good year already. We've taken a lot of profit this year. We've limited our portfolio a lot over the last couple weeks. Yeah, these larger streams are chaos, dude. So many people show up. We had like 5,000 people here today. At the peak at 2 p.m., there's so many people here that the chat moves so quickly. I can try to answer questions and stuff, but it's just, yeah. It's fun. It's exciting. It gets your adrenaline going, but it's also kind of stressful. Yeah, so Nvidia earnings are going to be after the closing bell at 4 p.m. We're going to stream the entire release, the entire earnings call, and everything like that live. In fact, I'm going to get that stream ready right now. And again, just to recap the FOMC Minutes report. You know, I've got some cliff notes that show dovish, some cliff notes that show hawkish. Most policy makers noted risks of easing too quickly, basically cutting rates too soon, stopping quantitative tightening too soon. Trying to limit hawkishness too soon is a risk, right? Because inflation is the risk. Again, last week we had CPI, PPI inflation data, the consumer price and the producer price index. Both of those came in higher than expected. And I believe higher than the previous one as well, but I'll have to check that one. But inflation risks are still there. And the Fed, look, and I know like conventionally people think, oh, well, like, everybody wants a strong economy. That's not always true. You know, we've already had, like, in 2020, disaster struck. One of the Fed's tools to combat that disaster is quantitative easing, money printing, pumping money into the markets. The real way it works is like the central bank creates digital orders out of thin air, basically, and uses that to buy bonds and inject liquidity into the market. Right. Eventually, we get stimulus checks and all this stuff. Basically, the point is to lower interest rates. You know, the point is to make banks lower interest rates. That's what this is all for, right? Quantitative easing, that is. And so in 2020, after the pandemic, that's what happened. Interest rates were low. The Fed injected liquidity into the market. They expanded their balance sheet. They printed money. And one of the consequences to that, because they had to save the market, again, disaster struck. One of the consequences to that is that people start spending more money. When people have to pay less in mortgage payments, they can spend it on other things. When stimulus checks hit, they can spend it on other things. All of this contributes to higher prices. And again, a year and a half ago, we had almost 9% inflation. So the other side of quantitative easing is called quantitative tightening. It's essentially the opposite of quantitative easing. It's the Fed reducing their balance sheet, taking away liquidity from markets, and the goal, as well as rate hikes, the rate hikes are part of it as well, but the goal is to lower inflation, right? So the question is, when does the Fed start cutting rates? We don't know. A lot of people think next month for the next FOMC meeting is simply too soon. A lot of people think it's just too soon. I agree. I think next month we're not going to cut rates. I think it's a bad decision if the Fed does it. I think we'll have to wait until at least June. Personally, I'm going to go with June for when the rate cuts start. But we don't know when it's going to be. A lot of people are saying, well, interest rates are too high. Buying a house is too expensive. I know. And the question is, when does quantitative tightening stop? Because quantitative tightening impacts interest rates. With quantitative, when QT stops or slows, interest rates tend to go down. Rate hikes stop. Cutting rates helps interest rates as well, right? So it all plays a factor in lowering interest rates to consumers. When does that start? I don't know. We have to have inflation under control first. We can't just stop because real estate agents are mad or whatever it is. We have to stop when inflation is under control. And again, the Fed looks at PCE data, personal consumption expenditure data. And it's a weird market. Like I said earlier, it's a very strange market in which typically with quantitative tightening, it can negatively affect stocks and equities because less people have money to spend on stocks. People have less money to buy Apple and Amazon and the S&P 500 if, QT is in effect, typically. But during this period of QT that we've had, the equities market's been running. You know, mostly due to AI and tech and those crazy gains in Nvidia. And Nvidia earnings are in an hour and a half. Nvidia is going to release their earnings report. We're going to stream it all live. That's certainly going to impact all of it. It's a weird market right now. We don't know when they're going to cut rates. We'll see when that happens. You know, that's essentially what's going on right now. That's kind of the situation we're in right now. Just so y'all understand, like broad macroeconomic situation. That's basically where we're at right now. And so again, we can look at the poll and see who wants to cut rates. But yeah. What happens to the market when the Fed cuts rates? We don't know. In theory, it should run, right? It's a more dovish Fed. In theory, again, here's just basic economy theory. In theory, it should run. Although historically, it hasn't always acted that way. But in theory, a more dovish Fed, lower interest rates to consumers will unlock money to consumers and allow them to spend it on investments like the S&P 500 in theory, but sometimes theory doesn't play out. Again, by the same theory, quantitative tightening should push down the equities market, and that's not what we're getting right now at all. So again, it's all in theory. We'll see. Anyways, we got Nvidia earnings coming out pretty soon. We're going to get ready for that. Whew, I'm out of breath. Y'all got me talking too much over here. The last Nvidia earnings call we had freaking so many people here. When was this? We had this was in November. So we'll see what this one looks like. It's fourth quarter results. The last Nvidia call we had so many people. So do you think Nvidia is going to beat or miss earnings? Do you think they're going to react positively or negatively? Let me know in chat. Let me know what you think. All right, you guys ready? Let's do Nvidia earnings. Quarter 4 results. We're getting everything ready now. Bear with me, team. Pun intended, I guess. Nvidia down to 668. Gold up to 2030. It's pretty flat there. Pretty flat there for gold, though. Tesla testing lows of the day. All right, guys, Nvidia earnings stream is coming up soon. I'm going to go get my headphones for this one, but yeah, the Nvidia earnings stream's coming out soon. Y'all be ready. Again, if you haven't already, check out Top Step, check out my other sponsors. You shouldn't have to go anywhere. Again, you shouldn't have to go anywhere. You shouldn't have to leave. We should be able to cover all here. All right, so just if you haven't already, if for whatever reason it doesn't redirect you, as soon as we close this stream, it should immediately redirect you to Nvidia earnings. If it doesn't for whatever reason, here's the link right here. Check it out. If it doesn't for whatever reason, here's the link. And with that said, we're going to get ready to head on over to Nvidia earnings. Let me make sure we got... Let me make sure it redirects. Forgot to put it in sub only mode. I'm just gonna allow you guys to take that W. So there is no rate decision today. It's a recap or a reaction to the last meeting, Mo. Yeah, I'm live streaming Nvidia. We're gonna mosey on over to that stream right now. Again, as soon as we close this stream, it should immediately bring you to the Nvidia stream. If it doesn't, for whatever reason, yeah, if it doesn't for whatever reason, go to the link in chat we just put up, and yeah, we'll see you guys over there. We got that live. All right, so yeah, we're gonna start that stream here. All right. I'll see you guys over there. Again, if it doesn't bring you there, just go to my channel and find the Nvidia earnings stream. But we're going to close this one down. It's going to bring you to the Nvidia one.